The Dhandho Investor Summary Part 1. What is Dhandho Investor? It is based on one key premise, that the key to generating high returns with low risk is by taking asymmetrical bets, in other words, making investments that have a high potential for major upside, and also have a very limited downside. Another way of thinking about asymmetrical risk is, heads I win, tails I don't lose much. This low risk, high return approach to investing is what Monhish calls the Dhandho method. And in the book, he shows plenty of real-life examples that prove that the Dhandho method works. One of the most remarkable examples he gives of the Dhandho method in action is the story of the Patels. The Patels are a small ethnic Indian group that came to the US in the 1970s with nothing, and using Dhandho investing principles, the Patels went on to become the largest owner of motels in the entire country. How does a penniless family of immigrants go from $0 to $40 billion in motel assets in the span of 35 years? The answer is, the Dhandho method. The book synthesizes the Dhandho method into 9 key principles. So let's go over each of these 9 principles. Principle number 1, focus on buying existing businesses. Remember that the whole Dhandho investing framework can be summarized into this one tagline: heads I win, tail I don't lose much. And since existing businesses are much less riskier than startups, Monhish recommends investing only in companies that have a proven business model and a long, stable history of operations. And the best way to do that is via stocks of publicly traded companies. If you examine the performance of various asset classes over the past 100 years, you'll see that stocks do better than all the other main asset classes. Not only that, but it's the easiest way to become a business owner. When you buy a stock, you get an ownership stake in the business, but you don't have to actually run the business yourself. The business already has a C.E.O and it's fully operational, so you get to reap the rewards of business ownership without doing any of the heavy liftings yourself. Plus, you can do this with whatever cash you have in your wallet. As long as you have enough money to buy one share of the company you want to invest in, you can afford an ownership stake in any publicly traded company. This is way more accessible than buying an entire business like Papa Patel did when he bought his motel. So to summarize the first principle of Dhandho investing, focus on buying existing businesses, and do this via the stock market. Principle number 2, invest in simple businesses. The Dhandho investor avoids investing in complicated companies. Why? There's actually a very numbers-driven reason for this. In order to assess whether an investment is a good deal or not, you need to first know the intrinsic value of a business. If you can buy the business for less than what it's worth, it's a good deal. If you have to pay more for the business than what it's worth, it's not a good deal. The general formula for estimating what a business is worth, or its intrinsic value, is by adding up all the cash flows, discounted at an appropriate interest rate, that will occur during the life of the business. That's pretty reasonable, right? A business's worth is derived from the cash flows that it will generate in the future. This is called a discounted cash flow analysis. In the book, Monhish explains this with the example of the neighborhood gas station. Let's say that the owner of the gas station puts it up for sale at a price of $500,000. You know that after 10 years, the gas station can be sold for $400,000, and meanwhile, the gas station will put $100,000 in your pocket every year for the next 10 years. That gives an estimated timeline of cash flows that looks like this: $100,000 every year for 10 years, plus a lump sum of $400,000 in the 10th year. And because these cash flows are future cash flows, they have to be converted into present day dollars. If interest rates are 10% right now, then the present value of these cash flows look like this. Comparing future cash flows in present day terms ensures that we're comparing apples to apples, since the purchase price is also in present day terms. The sum of the cash flows, in present value terms, is $768,000. This is what the business is really worth. So is it a good deal? Well, considering that you can buy the gas station for $500,000. It's a great deal, because you're paying a lot less for the business relative to its intrinsic value. Discounted cash flow analysis is hands down the best way to assess investment opportunities, but you can see that estimating future cash flows is not an easy task. Even with the gas station business, which is a really simple, stable, and predictable business, the cash flow estimates we used aren't 100% certain. When it comes to predicting the future, nobody has a crystal ball. That's why the Dhandho way to deal with this uncertainty is to invest only in simple businesses where the future cash flows can be estimated with relative confidence. The cash flows of a gas station are a lot more estimable, is that even a word, than the cash flows of, say, a biotech company that's still in the research phase. So rather than try to predict the future of complicated companies, the Dhandho method wants you to simply avoid those kinds of companies and stick with the ones with relatively predictable, stable cash flows. As Warren Buffett says, change is the enemy of investments. We look for mundane products that everybody needs. Examples of businesses like this are motels, as in the Patel story, Coca-Cola, which was Warren Buffett's most successful investments, or Bed Bath & Beyond, which Monhish uses in the book to walk us through a DCF analysis. Principle number 3, invest in distressed businesses. In distressed industries. Now that you understand how to calculate the intrinsic value of a business, you now have a powerful tool for finding great investment opportunities. Just like with the gas station example, where you could buy something worth $768,000 for only $500,000, you want to buy stocks at less than their intrinsic value. The best way to do this, according to Dhandho, is to look for distressed companies. Going back to the story of Papa Patel and his motel investment, he bought the motel in the 1970s. During a very troubled time in the economy. The country was in a deep recession and you could pick up motels at fire sale prices. You can also do this in the stock market. Because stock prices are so volatile and driven by news headlines, the market can be very emotional. This often creates huge dislocations between a stock's price and its underlying value. So what you're looking to do is buy a stock when it's trading at a distressed price. The third principle of the Dhandho investing framework is perfectly summed up by this quote from Warren Buffett: I will tell you how to become rich. Be fearful when others are greedy. Be greedy when others are fearful. Principle number 4, of the Dhandho investing method, is to buy businesses with durable moats. A moat is a protection from enemies. In medieval times, a castle needed to have a moat in order to keep out its enemies. The wider and deeper the moat, the greater the protection. It's the same for businesses. Thanks to free market capitalism, competition in any industry can be brutal. If a business doesn't have some sort of competitive advantage, they'll get wiped out pretty quickly. How do we know for sure if a business has a moat? You can look at the financial statements. A business with a strong moat will have a high return on capital. This is a metric that tells us how much income business is generating with the capital deployed in the business. Examples of companies with moats are American Express, Coca-Cola, Harley-Davidson, and Google. Moats can come from having a brand name, a cost advantage, economies of scale, and so much more.